Hey, I'm often asked the question, what I think is like the best investment right now in this current market? It's exactly what we're talking about today on the show. So tune in. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You work so freaking hard for your money, and you're now ready for your money to start working harder for you today. You want that freedom. You want the cash flow. You want to become work optional, where you work because you want to, not because you have to, because you have enough passive income coming in to be able to do what you love with those you love. And it's not just about getting rich, although that's a great byproduct too. But it's about living a rich life because as you're blessed financially, you have a greater capacity to bless the lives of all of those around you. And that is a ripple effect I'm here to create for you today. Thank you so much for tuning in. You've been binging. And guys, now we're over 900 episodes, 11 seasons in. This is all because of you. So thank you so much for being a part of our tribe, be a part of this community, and make it thrive and grow just as it has today. Hey guys, if you haven't been following us on social media, and if you happen to use social media, follow us. We've got everything from X, used to be Twitter, right? Now it's called X. I have to remember that, to Instagram, to TikTok, Facebook, LinkedIn. We're everywhere. Just look up Money Ripples and follow us there today. Okay, guys, so I'm bringing on Heather Dreves today. Now, Heather, you guys may remember her if you've been on here long enough. We've had her on before talking about really what has become for our clients as well as for myself, kind of like the hottest type of investment to do over the last couple of years, which is note investing, right? How do you invest in debt, versus just equity? How do we make money off of debt? How do we essentially become like the bank? And I'm not talking about infinite banking. I'm talking about becoming like the bank where you lend the money, you have the collateral, and you have that ability to create massive, awesome, stable, predictable returns off of your money. That's exactly what Heather does with Central Lending. You've heard us advertise them on this show before, but now we have Heather with us today. By the way, she has helped manage and raise over $300 million in this space over the last 18 years. And not to mention that, she's also got a major cool factor because I know she loves working out. She was a former collegiate soccer player too, and she's got a son that's I think gone pro or almost pro, maybe
College.
collegiate, college still. Yep. So, anyways, excited to have Heather on today. So, Heather, welcome back to our show.
Absolutely. Thanks for having me. I'm excited to be here too. This is probably one of my favorite topics to talk about.
Yeah, I don't think I've ever asked you the question. How'd you go from soccer to this?
That's a funny question. Well, I actually went from soccer and went into college, actually playing soccer, and had multiple injuries, knee injuries, which are very common in women's sports. A
Mhm.
couple of blown ACLs, and decided that, my soccer career was probably over. Finished up college and thought I had aspirations of being a teacher. But at the same time was also, while I was in college, working a sales job. Funny enough, selling furniture.
Mhm.
And I kind of got the sales bug. And long story short, fast forward, 8, 9 years down the road, my husband and I had two boys. And I stayed home with them till they were in school full time. And I had a friend that was in the private money space. And one day I called him up, and he and I had actually sold furniture together back in the day. And, he started telling me about what he was doing. He said, "Hey, why don't you come in the office and, we'd hire you." And I honestly knew nothing about private money.
Wow.
I grew up with that understanding that my parents had taught me that when you wanted to borrow money, you went to the bank. And when you wanted to invest money, you went to your investment advisor or financial advisor. And that's just what everybody did. And so my eyes were opened over 20 years ago. I was like, this world was out there that if you had a good deal, you could get private funding and you didn't have to go through the pain and suffering of going through a bank.
Right.
And on the flip side of it, if you were a passive investor, there were, great yields out there to add to your maybe traditional portfolio. And, just was kind of exposed to all of that. And now, fast forward over 20 years later, I use private money for my funding for the real estate deals my husband and I actively buy. We passively invest. And, in my 20-year career, I've been able to help a lot of people, to your point, create wealth for themselves, live very rich lifestyles, be able to financially give back to their family and communities and churches. And so it's just been this really gratifying career. I never planned to do this. I didn't even know this world was out there, but really am just extremely thankful and blessed that, I was exposed to it. It's been pretty life-changing for me and my family.
Absolutely. Yeah. Well, talk to us a little bit about, because I'm coming from the perspective, like, I remember my wife even asked this too. She's like, well, I always invest in equity. Why would I
Yeah.
invest in debt? I
Yeah.
said, well, I've just learned debt is safer than equity, which is the opposite mentality we're always taught. We're always taught to own things,
Yeah.
not to owe things, right?
Yeah.
Tell us about that. Like, what's your perspective on using debt as an investment?
I think equity and debt are both useful for their own reasons, right?
Hmm.
And I think what people need to understand is, equity, a lot of times these equity opportunities out there, whether they're syndications or you're buying your own deals, you're really relying on what that future investment is going to be worth, right?
Hmm.
That's where you hit your home run. You're probably, investing or at least buying a property on the cheap with the intention of adding value to it, whether that's through, rehabbing it, if it's commercial, maybe you're getting it leased out and making improvements. But the whole goal is more of a long-term investment, and you're going to hit your home run probably 4 to 5 years down the road when you sell that property and realize the equity you've made in that deal. I get a lot of investors though that are at this time in their life, not everybody, but many of them are, retired, or they've sold a business, or they've sold a dental practice. You and I both work with a lot of dentists, and they've become accustomed to a certain lifestyle, and they are looking to now have their money work for them instead of depleting everything they've saved up their whole career. And they want to continue to live these lifestyles. And I think that, debt can provide that. It does provide cash flow. If you're investing in the right debt instrument, you should be secured very well with a lien against a tangible piece of real estate, whether that's commercial or residential. So, at the end of the day, when you look at these investments, you have to look at these and say, what is the risk? And if things don't go as planned, how do I get out of this deal and get out whole? It's great that you can get high yields on your money, but I think at the end of the day, most people want to know that their little nest egg is safe and they're not going to lose any of their investment. Now, there's always risk, like just for transparency and clarification, like there's risk in any investment you do. But I think you have to go into these with your eyes wide open and say, hey, if this is plan A and plan A doesn't work out, what's the backup plan? And I think that you have that with debt because you are essentially the bank, right? You're
Hmm.
doing exactly what banks do. You're investing your dollars into a tangible asset, which is a lien against a piece of real estate. The goal may be for you to cash flow and start to get monthly passive income. Some people are also looking to just compound and reinvest, which is that you have that ability in a debt fund. But I think it is a little less risk adverse, or more risk adverse because you have that tangible piece of real estate backing it up. Also, in a debt fund, your investment is diversified over multiple assets instead of relying on that one piece of real
Hmm.
estate to perform. And if it doesn't perform, your cash flow can be affected. Maybe your principal is at risk. When you're in a true debt fund like what we manage at Central Lending, we have 400 debt instruments in there. So,
Hmm.
the reality is if one borrower is late and not making their payments, you're not going to see the effects that much because you've got all these other performing assets in it. So you truly are, in my opinion, more diversified in a debt instrument as far as a debt fund goes. Promissory notes are a little different because you're
Hmm.
typically one investor buying a promissory note. But debt funds over the last couple of years have become extremely popular because of those reasons.
Oh yeah. Well, it's the places that people see a lot less risk, than it
Right,
has otherwise. Now, your
right.
your debt fund accredited investors only, correct?
That is correct. Yep,
Yeah.
we can accept dollars from accredited investors only with a minimum of 50,000.
Yeah. And then non-accredited, we'll talk about that too, because I know there's
Yeah,
options
there's
there
some
too, of
options.
course. But one thing that kind of was my epiphany in the last year, even though I've known it, but
Yeah,
like because I was kind of like siding with my wife. I was like, yeah, you want equity, you want ownership, right? And I know even Kiyosaki's like, you want control, not ownership. And I was like, well, I
right.
get that. But what kind of hit me was when I started comparing like what you do to like someone who just buys a house for
Mhm.
themselves, like buys their own home. you always think, oh, I own the house, right? And some people say, well, I own it with the bank. It's not really
Yeah.
mine, but the truth is, no, you own and control that home. However, when I go to sell that house, who gets paid first? It's always
Yep.
the bank, right?
The
They have to
bank.
get paid
Yeah.
first. And then whatever's left over, I get paid as the equity investor. So debt investors get paid first, equity
Hmm.
investors second. And I started looking back, it's like, man, with all these people that put money in apartment syndications and whatnot. And that was a tough time, even for the best of syndicators,
Yeah.
really rough time go. But those that were in that equity position were the ones that were like, man, am I going to lose all my money? Were those like that were in the debt position, whether it be the bank or sometimes it was even investors that just put up a lot more money, but they became in the debt position. They got paid first. And then it was
Yep.
only then equity investors might get their money back.
Yeah, that's a
Uh,
really good point to bring up. And that
Yeah.
comes up often, I get a lot of investors like at if I decide to exit or you decide to wind this fund down, how does the priority of payments happen? And you are correct. Debt is paid first, equity is paid last.
Well, and that's where I know banks try to lessen their risk. That's why they want bigger down payments. So there's more equity in the property, right?
Hmm.
What's your typical loan to value that you look for, whether it be in the debt fund or even in your
Yeah.
individual notes?
Yeah, and something to understand is, and we'll touch a little bit on the individual notes. Those notes that we sell are the notes out of our fund. So
Mhm.
they're all coming from the same pool.
Yeah.
But maximum loan to value is 70%.
Oh, nice.
We typically require our borrowers to bring in anywhere from 20 to 30% of the deal in cash. We
Mhm.
like skin in the game. That's a big component of debt lending. I 100% funding is risky because at the
Yeah.
end of the day, if that borrower has some challenges and hiccups, we always ask ourselves, what's going to keep them there paying and figuring out a solution to pay us off? Most of
Hmm.
the time, when you are lending 100% funding, it's much easier for borrowers to just wash their hands and say, well, it didn't work out. We'll chalk this up to a bad deal. And as the lender, you're sitting there holding the bag. So we want
Right.
to see them bringing some money in. We want to see at least 30% equity cushion in the deal because the things you have to take in mind are, okay, if I do get this back, I'm going to have to foreclose. There's costs for that.
Is
You're
that
probably going to
before or
have
after
to
repair value? The 70%.
it depends. We do lend up to 70% of the after repair value. So
Hmm.
for everybody on the show today, that is a value that is determined by what the property's worth as it sits, as well as what they're going to do to the property. So if they're providing a value add or they're rehabbing it to increase the value, what's that value look like after it's completed? There are some things that we put in place to make it less risky, meaning we don't give the money to them to just go rehab it and hope they get it done. We actually retain all the rehab funds. We make sure we have third-party inspections that go out, confirm that the work's been done, and then we will reimburse our borrowers for that work and the materials. But we will never front any costs because, the concern is that they take off with the money and don't finish it.
So in some ways, you're even doing less risk than like a construction loan from a normal bank, correct? Because
Yes,
they'll give them the money up front, and then
right.
they hope that they get it all done versus they take off the money or whatever it might be. You're saying no,
Yes.
you get the work done. Once that work's done, then we give you the funds to
Yeah.
reimburse you.
Because there's so many logistics to that. These
Yeah.
people are using subcontractors. You have to make sure you have lien waivers signed, that contractor's verifying he's been paid. You don't want to have
Mhm.
somebody come back and file a mechanic's lien.
Mhm.
You don't want to say, well, here's $20,000 for flooring, and they go off and spend it on another project and don't buy the flooring. So it's the easiest way to mitigate risk that we can find, and then also having a third party going out, putting eyes on the property because we lend all over, right?
Yeah.
We simply cannot have somebody in every area that we're in, but we can rely on good third parties that can go out there and determine, yes, the work's been done, or no, they've done nothing. And that has happened, and luckily when you hold the bag of money, they're a little more inclined to work within your guidelines. And, we want to make sure that our funds are safe, our investors' principal is not at risk, and that's just the easiest way to do that with rehab funds.
Yeah. Well, walk us through. That kind of leads me to that next question. When we go back to the individual notes, right? The ones you can
Mhm.
actually offer anybody, no matter if they're a credit investor or not,
Mhm.
they get an individual note. First, like usually how much money would somebody have to expect to put into a note? And then the second question would be is what happens if something goes wrong? What would they
Yep.
do in that situation?
Yeah, so let's talk about minimum investments into promissory notes.
Yeah.
We have closed loans at $20,000. We don't really love those kind of deals. When you're things to think about when you're looking at small dollar notes is, an equity percentage. So to say that we have 30% equity is great, but 30% equity on a property that's worth $400,000 is very different than 30% equity on a property worth
Yeah.
$40,000, And when you're looking at things like foreclosure costs,
Yeah.
and things of that nature, attorneys don't care that your house that you're trying to foreclose on is a $40,000 house versus a 400,000. They don't price foreclosure costs according to the value. So I tell people to keep those types of things into consideration when you're reviewing these deals.
Mhm.
But I'd say probably like the lowest we'll go down to that you see, somewhat regularly from us is about $40 to $50,000. You do have to buy the whole note, so that's why I
Mhm.
say that's kind of the minimum I would tell people to have
Mhm.
in hand if you're looking at promissory notes from us.
Yeah.
Because the other thing is when you're down around 20, 30,000, you're probably in a very distressed area as well. The
I got a few
property's
bullet
maybe
holes
worth.
for air conditioning, right?
Right. Yeah. Yeah. So, you just gotta, it's like the big picture, right? Look at
Mhm.
all of it. But yeah, I would say 40 to 50,000 would probably be a decent amount of money to start looking at notes. And obviously they go up from there. I mean, our average loan size is about 180 to $200,000.
Yeah.
So, like you said, they don't necessarily have to qualify as an accredited investor. However, they do have to buy the whole note. We won't break
Mhm.
it up. I'm not going to go sell you, Chris, 50,000 of a $100,000 note and then find some other guy to buy the other half.
Well, it just gets
Um,
messy. Yeah.
yeah, it is messy from a servicing perspective. And like you said, most note buyers that are really active promissory note buyers, they like it because they're the only guy in the deal, right? Like at
Hmm.
the end of the day, if something goes bad, you get to make the decisions. You're not in a fund environment,
Hmm.
and so it's really just people's appetite. But yeah, I would say that's probably average dollar size. They're about 12-month loans. We don't do really write anything longer than 24 months. And you can get in the double-digit returns. Ours are always in a first lien position. Borrowers have to make monthly interest payments. So for people that want cash flow, that's very nice, providing the
Yeah.
borrower's making their payments. But one of the other questions you asked is, what do they do once they buy the note? Because there's a lot of people that sell notes out there that are like, good luck, Chris. Now you own the note and now
Yeah.
it's your problem. We actually stay in the deal, meaning that we service it. We don't collect the payments. We do use a third party to actually pull the payments from the borrowers. We set them up on ACH and then they disperse it to the investor. But we are going to stay in the deal in the sense that we're going to help you with it. Like we're going to be the ones calling the borrower if they miss a payment. We're going to be the ones making sure they're paying their property taxes and their insurance. You're never going to have to, at least with a promissory note from us, have to deal with the borrower. We don't want you to have to do that. We want to
And
be on the front
yeah.
line, communicating with the borrower, and we will always come to you for decisions to be made. We're never going to, make decisions without your okay and your approval, but we will be the ones communicating it. So
Yeah.
technically, we service it for you, other than collecting the payments. And it's people love it. Like that's, I think, one of the biggest concerns most promissory note buyers have is what happens if they don't pay? Like, how am I
Mhm.
going to manage this? Who's going to manage it for me? We'll even go find you an attorney if that's the case, if you need to find a foreclosure attorney.
And that's the thing. If it goes into foreclosure, that means the property's theirs, right? The investor in this
If it
case,
goes
right?
all the way to foreclosure, I mean,
Yeah.
I'll tell you, we've funded about, I think it's like 460 notes since 2016, or actually more than that. It was 1,500. That was for a couple of years, 1,500. And we have foreclosed on 7 loans in that entire lifetime. So
Wow. That's
what
like a half
technically,
of
what
1%.
yeah, typically what happens is it's not to say that a lot more don't stop paying and
Hmm.
have challenges, but it's a lot of it's just coaching the borrowers like, hey, what's going on? And sometimes it's their contract or sometimes the tenant
Hmm.
didn't pay them. And it's a matter of really just kind of coaching them and educating the borrower like, hey, here's some ideas of some solutions and let's get you back on track, or like, hey, let's try to get you refinanced. And sometimes they can't sell them and then they go throw a tenant in it and they have this bridge loan at 11, 12%, which doesn't make sense,
Yeah.
and they don't know that they can actually get a 30-year rental loan
Right.
that we actually offer. So most of the time, as long as they're communicating with us, we can help them. So very few actually go all the way to foreclosure. But if they do, then it's an REO, it's a real estate owned. Now you own that piece of real estate, which sometimes isn't a terrible thing.
Yeah. Well, and that's another reason why you want them to have one, their own skin in the game, their own money in it.
Yep.
Two, there's equity. Anyways, they want to get that
Hmm.
equity out because otherwise, we get the equity, as
Yeah.
investors that way, right? So,
Yep.
not that we want to foreclose, just like any bank, no bank wants to foreclose. Like you're saying, you rather work with them and try to get it worked out
Right.
so that it's less headache. But, worst case scenario, you might end up walking away with more money than you invested.
Yeah. Yeah.
Yeah.
But
That's
it's important to
fantastic.
know the risks of it.
Yeah.
It's a useful product, and I have a lot of investors that are very successful funding promissory notes. They're probably, if I was looking at someone that would go into a debt fund versus that is a active promissory note buyer,
Hmm.
that promissory note buyer is probably more hands-on. They're very
Hmm.
hands-on. They want to look at the deals. They want to dig into them.
They want
They're
some
probably
essence
more
of
risk
control.
adverse. Yeah, they're
Yep.
more risk adverse. Like they're not necessarily counting on the cash flow,
Mm.
versus someone that goes into more of a debt fund environment. They're typically probably a more passive investor, like, hey, I just want to set it and forget it. I want to either, get my monthly earnings, or what's been very popular with our debt fund is you can reinvest your earnings.
Mm.
And that occurs on a monthly basis. So run the numbers compounding your investment over a 5, 10 year span, and the returns are very different when you're reinvesting.
Yeah, exactly. Well, that's fantastic. Now, I want to ask you this question. There's a few more questions I have for you, but
Sure.
I mean, obviously, we're planning on having Andrew, the owner of Central Lending, on this show as
Yep.
well. What was it that attracted you to work with him a couple years ago? Because, like you said, you've been in the space a long time. What was it that
Yeah.
just impressed you so much? You said, "Okay, there's something special here," because he's not like a big marketer. He's not like this
No,
big sales guy
no,
at all, right?
no, he's not.
We'll probably find that out when
Yeah,
we interview him, I'm sure.
yeah. Well, what's interesting is I was introduced to him several years back at a Verivest event, which is
Mm.
kind of a fund administrator. They used to put on some events. And I met him because we had a mutual client. So we both were sending deals to the same guy,
Hmm.
who's a very savvy investor, mainly a promissory note investor. And he's like, hey, you really need to meet this guy. He's super put together. But to your point, he's not a true salesman in the sense that he's out raising capital. He'd raised a fair amount himself, which was very impressive.
Hmm.
But he didn't have the time to focus on it because he's a data guy. Like that guy digs into the deals, he underwrites, like he's a numbers guy, but he's not the person that's going to be out there doing investor relations.
Yeah.
And so the biggest thing that caught my attention was his default rate,
Yeah.
because that was not the default rate from the firm that I was with. And it's not to say that they have a bad model. Every firm is different in their risk adversement, and if you're going to do riskier deals, which there is a opportunity there, you have to have the infrastructure, right? Like
Hmm.
you've got in-house legal, you've got a massive servicing team, you're looking at these deals like, hey, they don't pay, we're going to take them back. To your point, we've got potentially 30% equity. We might get 20% returns on our money by taking this property back and getting rid of it. So I just don't want to I don't want to say that they have a bad model, but
Hmm.
it's also very wearing to deal with those kind of assets. There's just constant problems, and
Yeah.
I can't tell you, I maybe have a handful of my hundreds of investors that really are really risk adverse guys that are like, yeah, I want to take this back. Most of my people just want to get their investments. They want to get their earnings, they want to be able to reinvest, and they want to know that they can sleep at night and that their investment is safe.
That's
And there's
me. Yeah.
capital preservation. And so I honestly didn't believe him that his default rate was what it was. And so we started talking for about a year before I actually moved over. And I said, I want to see this. And so he started sharing his reports. And the quality of paper that we underwrite for a private lender is extremely conservative. And
Mhm.
the second thing that impressed me wasn't just the quality of paper, it was who he was selling it to, because we sell probably 80% of our portfolio paper to institutional capital, which if you've been in the private money space, it's pretty unheard of, because
Yeah.
most institutional capital looks at us like we're risky and we just lend to anybody. And if they can fog a mirror, we give them a deal. That's not true. And so when I started really digging into the quality of the paper and And the third would be his track record with his funds. They've returned incredible returns. And I was like, I don't believe that either. Like, funds have lives, and
Mhm.
sometimes one year is great. And so once I started getting all the data and actually seeing evidence of that, I was like, oh my God, like not only is this a less stressful work environment for me, but now I have this amazing product to offer investors that over the last 2 to 3 years have struggled. There's been a
Mhm.
lot of, like you said, even good operators have not performed, and there's been a lot of disruption in the alternative investment world. So, for those reasons, I was like, I think this is just a sign. And 14 months later, I'm just happy with the move I made, and still able to work with a lot of clients I've worked with for 20 years. So
Yeah. Well, definitely
satisfying.
happy to have you part of our network. That's for sure. And so,
Yeah. Thank
everybody, we
you.
will put their link in the show notes for you guys. So you guys can take a look at that here. But Heather, I want to ask you one last question. Being
Sure.
that this is the Money Ripples podcast,
Yep.
we always ask our guests, what do you feel is your ripple effect that you're here to create on this planet?
I think just like I had said earlier, helping these families that I've worked with some of these families for over 20 years. Now I'm working with people I originally started working with, and now they're kids. And what I think is so satisfying for me is seeing how life-changing it is, not only for myself and my family and what we've
Mhm.
started to pass on to our kids, but helping other clients do that, and they're not just out there leading luxurious lifestyles. They're giving back to their communities. They're educating their kids. And so I think that's, probably the thing that makes me hit the ground running in the morning and, continue to do this.
Yeah, it's one of the reasons I wake up too, right? And why we do
Yeah.
this podcast for that very
Yeah.
reason. Yeah.
Yeah.
Well, I appreciate you creating that ripple effect and continuing it on even for our audience too. It's been a pleasure
Thank
having you on
you.
today.
Absolutely. It's my pleasure as well.
Well, everybody, there you have it. That's Heather with Central Lending. If you've watched any of our podcasts, you've already heard them before. Well, now you've got a face. Heather's the one you would talk to. So, anyways, guys, be sure to check out centrallending.com. And you remember, your life changes when you start to act on those changes. So go and make it a wonderful and prosperous week. And we'll see you later.